Hi there, I'm Kavita Bartake from Cherry Street Investments. It's 48 degrees in Texas, a little cold for us Texans, and hope you guys are all staying warm. I just wanted to talk to you today about 1031 exchanges versus opportunity zone investments. A lot of investors have been reaching out to me lately and asking questions about when they should do one or the other. So I wanted to take some time today to talk about the differences and similarities between these two investments. So I'm going to share a little screen with you about the differences and similarities between these two investments. I hope you can see that. All right. So here I have highlighted the differences between 1031 exchanges and opportunity zone investments. We'll start with the first one, the investment. The investment amount from an opportunity fund it only involves investing the gains from a capital gains event, whereas here in a 1031 exchange, it involves investing the entire proceeds. What that really translates to is, let's take the example of a property that I sold for $300,000. I purchased the property for $200,000, in which case my gains are $100,000. In a 1031 exchange, I would have to move the entire 300,000 minus any expenses at closing into the new investment, which is into a new property that you bought as a part of your 1031 exchange. Contrast that with opportunity funds. You only have to take that $100,000 from that investment or the gains from that investment and invest it into an opportunity fund. The second one is a source of funds. And probably the biggest advantage of opportunity funds that I find is that the capital gains can be from any source. So you have stocks, you have options, crypto, real estate, it can be a piece of art. It really doesn't matter. As long as there's a capital gains event and it generates a gain for you that you don't want to pay taxes on immediately, you can use an opportunity fund investment to defer the taxes. Whereas in a 1031 exchange, it has to be a real estate sale. It can be any kind of real estate, but it has to be a real estate sale, and it has to be a like exchange into another real estate. So that is probably the biggest difference I'd see between the two. Also, in an opportunity fund, you don't need a custodian. So what that means is when you sell the property or sell that investment, you have 180 days from when you sell, in both cases, to move that money into another investment. Now, in the case of 1031 exchange, you have to send those funds at sale to a custodian. You cannot move it into your account. And if you do, you can't do a 1031 exchange anymore. Whereas in an opportunity zone investment, it could hit your account, and then you don't have to need a custodian. You just have to invest the gains into an opportunity fund within that 180-day period. Also, with respect to investment location, a 1031 exchange can be performed into any property in any investment in any location. Whereas in an opportunity zone fund or an opportunity zone fund, obviously is tied to a specific area we call opportunity zones. So it has to be within the opportunity zones. What this means is that opportunity zones are not necessarily the best locations always to invest in. So you have to be really careful about the kind of location you're getting into. There are some good quality opportunity zone investments available, which are investing into areas that have good median income, are probably going to be doing well in the long term, but not all locations are alike, and you really want to do your research before you make that opportunity fund investment. Also, the minimum hold for a 1031 exchange really doesn't exist. You can hold it as long as you want, but there is really no tax-free withdrawal. It doesn't matter if you hold it for 20 years, you again have to do a 1031 exchange, or if when you withdraw it, you will pay taxes at that point. Whereas in an opportunity fund investment, if you hold that investment for 10 years, you actually have tax-free withdrawals of all the gains within the fund. So let's take our $300,000 example. So we had $100,000 in gains in the first example that I took. Now I put that into an opportunity fund, only the gains, right? So I have in 5 years, I have a 10% step up in basis. What that means is now my $100,000 gain is regarded as a $90,000 gain. So my taxes due will be on that 90,000. So if I break out of the fund at that point, you are paying taxes still. You're not getting away from paying them, but you're just paying less, and you have time to pay them. In 7 years, your step up will go up to 85,000 instead of 90. So you owe less in taxes. So, but your taxes are due before December 2026, according to the way IRS regulations are written for opportunity funds. In 10 years, any gains that you've made within the fund itself, this does not include the original gains that came in. So let's say I invested 100,000. In 10 years, my 100,000 became 200,000. Now, you still owe taxes in 7 years on that $85,000 portion, but that 100,000 you made within the fund is tax-free after 10 years. So that's really where Opportunity Zone shines, or Opportunity Fund investment shines, that it provides that tax-free component in addition to giving you time to pay your taxes and reducing your taxes with the deferrals and the step up in basis. I hope that helps make a good decision on what is the best way for you to go in terms of handling your gains from a capital gains event. Thanks for listening. Have a great day. Bye-bye.